As perhaps you might guess, there's not a huge amount of corporate news scheduled as we get ever closer to Christmas, and the only FTSE 100 firm in the diary for the coming week is copper miner Antofagasta. It's due to host an analyst day on Tuesday the 14th of December. That event aside, there is a select list of small and mid-cap stocks who are scheduled to release first half or full year results or publish a trading update. Names which may be worthy of note and further research could include the following, although do please note these dates could yet be subject to change. Recruitment specialist S3 on Monday the 13th of December, hybrid estate agent Purple Bricks, insolvency expert Begbie's Trainer and retailer Joules on the 14th, another retailer Currys, as well as Hollywood bowl and toy maker Character on the 15th, and hydrogen fuel cell electrolyzer maker ITM Power, and oil equipment and services supplier Petrofac on Thursday the 16th. Now, informative as that grouping may be, the headlines are likely to be hogged by the macroeconomic developments of the week and, more specifically, monetary policy decisions from 5 central banks. Now, this central bank bonanza is currently scheduled as follows: US Federal Reserve on Wednesday the 15th of December, Bank of England, European Central Bank, Swiss National Bank on the 16th, and the Bank of Japan on Friday the 17th, although that date in particular could yet change. Now, the only one of these, whether an interest rate is seen as even an interest rate increase is even seen as a vague possibility in December, is the Bank of England. And that comes after a decade of cuts, record lows, and in some cases even negative interest rates. However, markets are now so used to mixed messages from this fine institution after Mark Carney's era as governor and the bodged communication from his successor Andrew Bailey and new chief economist Hugh Pill in November, that investors will probably only really believe something when they see it. Both Mr. Bailey and Mr. Pill hinted at a rate rise in November, but then actually voted against. Mr. Pill has since hinted that strong jobs data and lofty inflation may indeed merit a rate rise, but we'll only find out on the 16th, not least because the bank does have the new Omicron variant to think about as well. Now, in terms of quantitative easing, the US Federal Reserve has started to taper QE at the rate of $15 billion a month. The Bank of Japan's just about stopped growing its balance sheet, and the Bank of England has slowed its rate of bond purchases. But in aggregate, the balance sheet of this august quintet of central banks has grown by, wait for it, $9.5 trillion since the start of 2020, that's 67%, $13 trillion over the last 5 years, that's 99%, and $17.4 trillion over the last decade, that's growth of 199%. Now remember, we're still just talking about tapering here, which means decreasing the amount of extra stimulus, so they're still providing monetary power for the economy. They're not sterilizing it or taking it away. Now, looking at this chart, do you really think they will withdraw some or any of that stimulus, as the central banks originally said they would when these policies were introduced as temporary emergency measures back in 2008 to 2009? And even if we do see tapering or even rate rises in the coming weeks or months, monetary policy will still be very, very loose, as central banks juggle inflation on the one hand and offset the potential danger there against unemployment, the Omicron variant, rising global debt piles, and fears that a tighter policy could puncture financial markets and prompt a drop in household wealth and asset valuations that then in turn weigh on the economy. It's not an easy decision, but it has important implications for financial markets. Given that monetary policy works with an 18 to 24-month lag, you could forgive some investors for getting worried that the major central banks are behind the curve when it comes to inflation, especially as we've seen 94 rate hikes in 2021 from central banks around the world, but none have come from the big five. Now, by country then, just to go through it very quickly, this is the current state of play, so you know what your benchmark is for each of these 5 decisions. On the 15th, the US Federal Reserve will assess whether to leave rates unchanged at 0.25%, where they've stood since March 2020, or accelerate its rate of tapering of quantitative easing from the current rate of $15 billion a month. That trajectory takes the QE bond buying program down from $105 billion a month to zero by June 2022, at which point markets think a first rate rise is possible. So, watch out for any change in those timelines. The Fed's balance sheet, by the way, currently stands at $8.7 trillion. Note that for the moment, markets are currently pricing in May 2022 for the first rate increase, albeit by the narrow margin of 53 to 47%. It's almost a coin toss. On the 16th, the Bank of England will vote on its interest rate of 0.1%, also unchanged since March 2020, and its £895 billion QE scheme. Remember that in November, the Monetary Policy Committee voted 6-3 to leave QE unchanged and 7-2 for no change in rates. So there was a slight shift towards tighter policy from 7-2 and 9-0 the previous time. On the 16th again, the Swiss National Bank will vote on its headline interest rate of minus 0.75% that's been in place in summer 2019, and whether to amend the trajectory of its balance sheet, where the last published number is total assets of 314 billion Swiss francs. And finally, on the 16th, the European Central Bank will decide whether to leave its headline interest rate unchanged at 0, a level that dates back to March 2016, and whether to taper its Pandemic Emergency Protection Programme, or PEP, which is due to run to €1.85 trillion between March 2020 and March 2022. As a result of that programme, the ECB's balance sheet now stands at €8.5 trillion. Remember that President Christine Lagarde has already pretty much ruled out interest rate increases until at least 2023. And to wrap up this lot, on the 17th, we are at the moment at least due to get the Bank of Japan. It's held its headline interest rate at minus 0.1% since February 2016, and QE is currently set at 180 billion yen a month. The BOJ is way ahead of the others in terms of QE, since its total assets of 728 trillion yen, or about $6.4 trillion, already equate to more than 100% of GDP, whereas in the US, Europe, and UK, the figure is somewhere between 30 and 40%. I hope that you and your families are all keeping in good health and good spirits. Thank you for watching, and I look forward to seeing you again next time.